Some quick housekeeping items. All questions need to be asked in the Q&A feature. You can also ask in the chat feature. Be respectful if you want to leave a comment in the chat. And if you would like to watch this program again, there will be a recording of it posted on our DoSpace YouTube page later, about later next week. I will post some URLs for that in the chat in just a moment. As a reminder, after each program, make sure you head to Beanstack, which is our community engagement program. There you can mark that you attended the webinars throughout the week, which enters you in to win some prizes. We're giving away 3 gift cards to local small businesses and 1 headshot session. You can do this at dospace.beanstack.org, which I will also put in the chat. So today we have with us Tony Schultz. He's a Nebraska Business Development Center. He is the Nebraska Business Development Center, Omaha Center Director. He has had over 18 years experience in the field of commercial real estate with focuses on operational management, marketing, budgeting, employee training, and tenant lease negotiations. Tony's experience includes assistance for small businesses in the retail, restaurant, and service-oriented sectors in the review of business plans, credit reports, marketing plans, financial statements, and business operations. During his real estate career, he achieved the designation of Certified Shopping Center Manager from the International Council of Shopping Centers, and he is a lifelong Nebraskan and passionate about making good businesses better in our state. So I will hand this off to Tony and he will get started.
Thank you very much. So welcome everybody to our budget tips presentation. A little bit about the Nebraska Business Development Center, just to give you some background. Our Nebraska Business Development Center main office is located at Mammal Hall at UNO here in Omaha, but we have small business development center offices throughout Nebraska. So whether you're listening to this in the western part of the state or maybe central Nebraska or eastern Nebraska, we have centers that cover all counties throughout Nebraska. The idea of the Small Business Development Center is the support of small businesses, whether it's startups, maybe they have been in business several years and they need help, or maybe they're in disposition mode. So there's a lot of different types of businesses and different cycles that we help. One of our main focus is assisting businesses with business plans and financial projections along with market analysis. So that's helping businesses that are going to lenders, going to the bank, and starting that lending process. One of those things that's really important is that business plan and those projections. So we help businesses with those. Our services are free, so the price is right. We are actually supported through the SBA. You'll see our little SBA symbol at the bottom, the Small Business Administration. They fund our programs along with our university systems and our state college systems. We also have a couple other parts of the Nebraska Business Development Center that are government contracting. So if you think about government contracting, it can be just about anything, janitorial services, parking lot maintenance, HVAC, electrical work, construction, all those things fall into that category. So we also have another division that helps specifically with government contracting. So no matter where you're at in the United States, there is a Small Business Development Center that can assist you. So we always encourage folks, whether they're a startup or they've been in business for a time, to reach out to their local center for assistance. So let's go ahead and jump into things here. So if we look at this, chaos to calm, hopefully today will help you transition from maybe the one stress to the one that's maybe a little more relaxed here. Some of the things that we hear from business owners or startups is, I don't have time for a budget. I'm trying to run my business. I'm trying to get things going. I'm focusing on operations. I've got to get employees hired. I've got to get the doors open. I've got to get the sales and the revenue going. I don't have time for a budget. That's one of the things we hear. Another thing we hear quite a bit is, I don't know where the money's going. So I'm creating revenue's coming in, it's coming into my bank account, but I don't know where the money is going. I'm not making money and I'm not really sure why. And the other thing we hear quite a bit is, I don't really know where to start. I don't really know how to begin the budget process, and I just don't know where to to start off at. And that can be frustrating. So what we want to try to get to is we want to try to transition to, I make time for budgeting. I know how to analyze my budget. I know what it means. And I have a plan to stick to that budget, to keep on task with that budget. And when we say make time for budgeting, one of the easiest things businesses can do is select one time a year that is budget time of year. And it can match your fiscal year. It can be one where it's a slower time of year, maybe towards the end of your fiscal year. There's a lot of different things you can pick. But the nice thing is if you always do your budget in the same month, you'll know each year as you come around to that time of year, it's budget time. It's time for me to start thinking about my budget for the next year, thinking about my projections, gathering my materials, that kind of thing. And if we do that, if we make it a specific time of year, it turns into a habit. And when it's a habit, it's something that we generally do more easily. It's not something we try to avoid. So that's one thing that you can do to maybe make the budget process a little less painful. Another thing you want to be able to do is analyze your budget. So it doesn't really do any good to put the numbers together if you can't analyze it and say, where do I compare to my peers? If I have a coffee shop, what are other coffee shops doing in terms of expenses and revenue? And how do I compare to that? And then if you do a budget, you have to kind of stick to it. You don't want to get out of control. I know expenses pop up here and there that you just don't account for. And you have to be able to kind of adjust things and adjust the budget to meet those things that pop up like that. So I want to try to go from that chaos to that calm. So the objectives we have with the presentation, and we'll go through these real quick, is learning how to start the budget. So beginning the process, beginning things, moving along, not avoiding it. It's a little bit like things that might not be fun to do for some people if they don't like numbers, or maybe that's not their thing. So starting the budget, it's really important part of it. Finding resources for the budget process. So we're going to talk about what resources are out there to help you out and help you build that budget. And then discovering how can it really help my business. We don't want to waste our time on something that's not going to help our business. We want to dedicate our time and our resources to things that are going to benefit it. And a budget is going to be a huge benefit to your business. A variance analysis is really important. It can help you figure out, where can I save money in my budget? Where do I need to make adjustments? So that's something we're going to dive into. And then contrasting benchmarks to the budget. So this is really looking at seeing what your peers are doing in terms of their expenses, their revenue ratios, and how you compare to that. And the nice thing about benchmarks is it can tell you, hey, I'm doing a great job in this category, or maybe I'm struggling in this category and I'm not really where my peers are at in terms of that expense to my revenue. So we're going to dive into all those things. So why do you need a budget? If you can benchmark your expenses to the industry, it's really going to help you tell where you're at in terms of those expenses. So an example is you compare your revenue as a percentage to your expenses. So if my rent is 8% of my revenue, and I look at my peers and I see that their rent is 4% of the revenue, that's kind of a red flag for me. It probably means I'm paying too much rent for the revenue that I'm generating for that particular space. So by benchmarking that, I can see, am I in line with my peers, the industry, or am I offline? Am I too high? Maybe I'm too low. And it works for other areas too. It works for particularly payroll, wages, and such. So if you look at your payroll and you benchmark it to revenue, and say I'm in the industry where my wages are 25% of my revenue, and I look at and I see that my peers, it's 35%. Well, maybe I'm understaffed. Maybe I'm losing money. I'm not generating income based on my low level of employment. Maybe I need to add employees. So benchmarking, so important. Getting an understanding of variable costs versus fixed costs. And we're going to dive into this more, but Variable costs, we tend to tell businesses variable costs aren't a bad thing. So think of variable costs as I sell one additional item of something, then I'm going to have an expense associated with it. If I'm a bakery and I'm selling cupcakes, my variable cost for those cupcakes might be the ingredients that I put in the cupcake, my direct labor to bake the cake and put it together. Maybe it's frosting. It might be the box I put the cupcake in, and it might be shipping to deliver the cupcake to the customer. So those are all variable costs, and those aren't a bad thing. We want to keep them down, but those, as sales go up, those variable costs will go with it. Fixed costs are the ones that are kind of a little bit more of a concern with the startup business. So the lower your fixed costs that you have, the lower your revenue can be and still make a profit or still break even. So fixed costs might be in the line of rent, utilities, insurance costs, marketing, wages, things like that. So no matter how many sales you generate, those fixed costs will stay even. So the lower we can keep those, the better it is. One of the reasons we do a budget is figure out, am I making money? Am I cash flowing? You can bring in revenue and put it in the bank, but it doesn't mean you're making money. So by doing the budget, you can really see, does my business cash flow? And if it doesn't, what adjustments can I make to either expenses or revenue or to both to make sure it does cash flow? Learning what your true expenses are. Sometimes we don't necessarily know what all expenses go into our business. And if we put together a budget and we're going along and we see something pop up, maybe in our checking account or a business account that goes out, might pop up and say, "Whoa, I forgot that expense in my budget. That's something I need to consider as I'm putting together this to determine if I cash flow." Tracking accounts receivable. If you're in a business where you have sales on credit, then it's important to track those accounts receivable to make sure they're up to date. And we're going to talk about kind of our payment cycles and the importance of that too. And then contrasting our budget versus our actual. So one of the things that's nice about a budget is once you put it together, if you enter in actual numbers each month, you can see, am I on track? Was I off in my assumptions? Does my budget match? Where does that hit at? And that's going to tell you what adjustments you need to make each month. If you have a huge expense come along that you don't expect, you may have to look to cut other expenses in the business or find a way to really increase that revenue to make up for that. Or you maybe have an emergency fund that you put funds into. That big expense comes up, you use your emergency funds, you draw those down. Well, you need to replenish those. So that's part of that adjustment and that analysis of your budget. And then one of the things we always tell businesses, whether it's a startup or someone that's been in business for a long time, always, always, always separate your business account from your personal funds. Never intermingle those two. We want those separate. Number one, it's easier to track business expenses versus personal expenses. It's easier to track revenue as it comes in and goes out. And it's easier to keep track of any draws. So if you do a draw from your business, it's easier to track it as it goes out of that business account and the personal account. Now, it's much more difficult if the funds are intermingled. If I go out to eat and it's not a business expense, that'll come out of that account. But then maybe I take out a client to eat, and that is a business expense, and it just gets confusing. So which ones are business expenses, which ones aren't? So make sure you separate those accounts. That's so, so important. All right, so we talk about benchmarking, and this is just kind of a sample of a benchmark. So, and when we look at this, we're going to look at revenue and its expenses as a percentage of revenue. So revenue is always going to be 100% on this particular benchmark form. And then we can see what the margins are, what the cost of sales are, cost of goods sold are, what the rents are, things like that. And as we go through, this one's from back in 2018. So if we look at cost of sales or cost of goods sold, it's around 12%. So we know that for every cupcake we sell, it's going to cost us 12% for that cupcake. And that may not be equivalent for a bakery, but we're just going to use that as an example for us. Now, our gross margin on this particular business is great, 88%. So that's a really nice gross margin. The owner's compensation is about 9.46%. Our salary and wages around 38%. Rent's around 5%. That's pretty low rent, occupancy cost or health ratio there. And we can go on down and see all the different categories here. Now, the main thing we're going to look at when we benchmark is how do we compare to the industry? So if I go down to rent, for example, and the benchmark is 5.06%, 5%, we'll call it, and I'm paying 10%, that's a huge red flag. Something's wrong there. Now, if I forget to put something in there, maybe I forget to put repairs in there, and I know that almost 1% of my revenue is going to go towards repairs, depending on what my revenue is, that could be a very significant amount. So keeping that in mind. And then salary and wages is really the big one. If we look at the expenses that are largest for any business, a lot of it is salary and wages. So think about how does that compare to the industry? If the benchmark's 37% and I'm paying 20%, well, that's probably a problem. I'm probably not, I don't have enough employees. So I might be losing some sales because I don't have enough employees. This is big on like restaurants, coffee shops, anything that's kind of a service related business where you have a lot of customers coming in the door and out the door. This salary is going to be a large portion of your expenses. So keep that in mind. The other thing that people want to look at too is, depreciation schedules. So, how much is my depreciation for my equipment in terms of my revenue? What are some other income sources? What do my taxes look like? So, and then what's my after-tax net profit look like? So, these are all things that are extremely important to benchmark. All right, so how do you really start in creating a budget? The first thing you do is just start making a list, and it doesn't matter if it's on a computer or grabbing a piece of notepad and paper, start writing down what your expenses are. And when we talk about expenses, go to that business account, pull up the last 6 months worth of statements and find out what those are and make that list, find out what those amounts are, record that down and see if there's anything that's missing. Now, if I'm a startup business, that's a little bit tougher because I haven't been in business before. Maybe I don't know what those are. That's when those benchmarks come in. So if I'm talking about a certain amount of revenue, I'm going to project 200,000 in revenue in my first year for my business. I can look at my particular industry. I can benchmark it and say, well, my wages are probably going to be this amount. My rent's probably going to be this amount. I'm going to make some phone calls. I'm going to reach out to people. I'm going to start building those financials. And Nebraska Business Development Center, my commercial here is that's something we can really help with is building financial projections. So that's something nice that a service that we provide there that's a free service. But check those accounts, do some research. If you're looking at renting a space, find out what rental terms are. How much is it per square foot? Are there any triple net charges that go in with it? And then find out what are the historical utility rates been on the space, things like that. Call your insurance person, say, hey, what should I expect to pay for liability insurance? And just gather that information, make those phone calls, gather that information. You can do Google searches and see what typical expenses are for businesses. So look for those and compile them, put them together. Now on the revenue side, it could be looking through invoices for customers. Point of sale software is great for that. Looking at all that and compiling those revenue sources and make sure you don't forget any. So, revenue sources can be all over the board or they might be really specific to your business. So be aware of those revenue sources and what those look like. And then lastly, look at debt service. So you need to build in your debt service into your budget. One of the things that a lender is really focused on looking at is, can the company pay their debt service? And if they don't think so, then they won't do the loan. So hopefully they do think so and they do that. So incorporate that into your budget. So resources on revenue, bank statements and expense statements, either one are great for that. So looking at that bank account, if you use a credit card, a lot of people use credit cards so they can get points for their business and things like that. We want to make sure that we're paying off the balance on the credit cards, because if you're not, it's in essence probably a 17% to 25% interest rate that you're paying for a loan. You don't want to use working capital for a credit card. You want to go to a bank and get a loan through that. The interest is so much lower. And then vendor invoices, go through vendor invoices that they send you in, check those. Point of sale programs like we talked about, and then any contracts you have. Don't forget to look at contracts. So they might be contracts with your landlord for your lease. They might be contracts for suppliers that you sign. So any contracts that you have in place, make sure you check those as you build your budget. Something else you can do too that we recommend is, if you're new and a brand new startup, reach out to someone that's in a different market. So if I'm starting a business in Omaha, I might reach out to a similar business in Kansas City or Des Moines or Denver or Cheyenne maybe. So reach out to that business and try to make a connection. And you may have to call 10 or 20 businesses, but you might finally hit one that remembers the struggles that we're starting up and may be able to provide some help for you. And you might be able to say, hey, how did you build your first budget? How did you build your first set of financials? And they may have some advice for you there. And once again, the NBDC is a great resource there too. So budget analysis. A budget is really no good if we just write a budget and throw it on a shelf and gathers dust. That really doesn't do us a whole lot of good. What we want to do is we want to be able to compare our budget to the actual numbers. And we want to find out what the variance is and what the various percentages. So in this case, we've got a flower shop. We've got flower bills here. We had budget 2,500. The actual expense was 3,221. Our variance is $721. Fairly significant variance, 28.84%. Generally, when you look at variances, anything in that probably 10% range should start getting your attention. If it's in that 20% range, it should really be starting to get your attention. Why was my budget so far off on what this actual bill was? Our natural gas bill in this case, we budgeted $550. Maybe it was a little bit warmer out, not this spring, obviously, but maybe it was a little warmer out. So we saved $128 there. We were down 23%. And then sales of flower arrangements. So we had budgeted 6,800. We actually sold 8,574. So we had a variance of a 1,774, 26%. So that's a good sign for us. Our revenue was higher than what we expected it to be. So Excel's our friend here. When we're building a budget, there's all kinds of software out there that you can use to build a budget. But if you don't want to go out and you don't want to purchase the software, maybe you're bootstrapping, you're just starting off, you can really dive into just a simple Excel program and build yourself a budget variance. So in this case, we're going to take a look at it. These are set up for the cells. So B3 would be basically the row B, 3 down, C3, and then we're going to do these different formulas. So looking at this, we're going to hard code our number in the first cell. So B3, we're going to hard code in what it was for our budget. So in this case, for our natural gas bill, we budgeted $550. For our sale flower arrangement, $6,800. We're going to then hard code in the actual. So we're going to type in whatever the actual was, and I would recommend doing this monthly, having a monthly budget and entering figures in monthly. And you're going to enter in this amount, and then you're going to hard code in the actuals here. Now, a simple formula, you just type in Excel equals C3 minus B3, or whatever these two cells might be. It might be A1 minus B1, or whatever they might be. So by entering in this formula here, C3 minus B3, this is taking our actual and subtracting our budget. So we know in this case, we were down $128, which is a good thing. This is on the expense side. On the revenue side, we were up 1774. So that's a good thing. So this is really, we're in good shape right here. Our gas bill was down and our revenue for our flower arrangement sales was up. So that's a good thing. I would definitely recommend in the Excel sheet. I didn't have a lot of room, so separate your revenue from your expenses. So you're going to have revenue in one section, you're going to have expenses in the other. And then on the variance, this is the formula for the variance here. So we're going to take equals negative B3 minus C3 divided by B3. So in essence, what we're doing is we're taking the budget minus the actual, we're making it a negative number. So it's going to give us a variance that matches what it is. And we're dividing by the budgeted amount. So the nice thing about Excel is you can just pull this up in the corner and copy it all the way down, and this will figure out all your formulas for you. Now, once you get your Excel form built, you're probably going to have multiple cells that you're going to have coverage on this. Go back and look and see where the big variances are at. And you may want to add a section of notes. So if I want to add a section of notes for this natural gas bill, I might put a note saying winter was warmer than usual. And that way that I know next year when I budget, I probably don't want to budget this 422 because we had an extra warm winter. I probably still want to stick with the 550 or maybe even a little bit above that if natural gas rates go up. Now for my sales, maybe I want to put a note in there. Did a huge wedding for flower arrangements. I didn't expect that. It was an enormous affair. That's where I got that increase in sales at. So I know next year, maybe I don't budget this 8574 in the revenue. Maybe I just budget the 6800, but I know in the back of my mind why that revenue is up. Now it's a repeat item. Maybe it's someone that's a repeat customer. It's a big convention and they ordered flower arrangements for all the centerpieces for the tables. And they said, hey, we're going to use you again next year. We loved what you did. I then know that I can put that in my budget because I have that note saying landed a big contract with ABC Conference Center and was able to get the flower arrangements for the conference that came to town. So adding those notes really helps you with your budget process. All right, fixed expenses versus variable expenses. So in the left-hand column we have, as you're looking at it, we have rent, insurance, payroll, utilities, marketing expenses, and office supplies. So think of those expenses as expenses that no matter how many cupcakes I sell or how many flowers I sell, I'm still going to have to pay that. I can't go to my landlord and say, I only had $500 worth of sales this month, so I'm not going to pay rent. They're probably not going to like that response very much. And I can't go to my insurance person and say, hey, I can't pay insurance today because my sales were down, or I'm not going to be able to pay my staff because, well, my sales weren't what they needed to be. So those are things that are fixed. They're there no matter what the sales look like. On the other side are variable expenses. So as I sell more cupcakes, as I sell more flowers, I'm going to have expenses that are associated with one additional unit of sales for that. And I have to figure that out. So what goes into the sale of that product? Do I have raw materials? Maybe I purchased the flowers from somewhere and I do the arrangements. So I may have a cost for those flowers, or maybe I go out to a farm and I harvest the flowers from there. Credit card fees is a big one. So every time I charge, a new customer comes in, they use a credit card, they charge, that's an additional fee that I'm going to have. If I don't have any sales, I don't have any fees. So it doesn't bother me a whole lot that I have those fees. As sales go up, those credit card fees are going to go up with it. And then shipping. If I don't have anything to ship out, I don't have any sales for my cupcakes, I probably don't have any shipping or delivery charges associated with that. So my products have to go out the door for me to have that expense. So take a few minutes when you get a chance, when you're putting together your business, write down your fixed expenses on one side, write down your variable expenses on the other, and that's going to help you build that budget. Because when you build a budget, you're not just building a budget on all your fixed expenses, you're also building a budget on your variable expenses. And as you project larger revenue amounts, those variable costs have to go up. So if my variable cost for $200,000 in sales is 10,000, if I double that and I do 400,000, then probably my variable costs I need to be at 20,000. So you need to make sure that you adjust those per your business as part of your budget process. Now, I want you just to take a couple minutes and we'll pause here for a second. Get out just a piece of paper if you have one handy, a pen handy. I want you to write fixed expenses on one side, variable expenses on the other. And what I want you to do is look at all these, go through and determine where you would place them. Would you place it as a fixed expense or would you place it as a variable expense? And then after a couple minutes, we'll kind of talk about them and we'll see how close you were on them. So go ahead and take a couple minutes, write them down, make your columns. And if you want to post in the chat, when you have that completed, that'd be great. Or if you just have access to Q&A, you can certainly post in there too. So. By the way, I see a couple questions have popped up and I will address all the questions at the very end. That way we can hopefully get them all answered or if I answer them somewhere along the way there. So good questions. Keep them coming. All right. Hopefully everybody's close. Just throw in a Q&A once you're all done. And you don't need to post the answers in there just to let me know that you've got it completed. All right. We'll go ahead and jump into it, take a look at it. So got some good answers coming in. Flour, if we're doing our cupcakes for each additional cupcake or whatever that we're building, we're going to need flour for it. So that's going to fall under our variable expenses. Chamber membership, the chamber doesn't really necessarily care what your revenue is. They're there to support you, to help you grow your business, but their fees aren't impacted by what your sales are. So that's obviously going to be a fixed expense. Baking pans. This is kind of an interesting one. We figure that baking pans are going to last quite a while. So we don't necessarily attribute them to each additional cupcake that's made. So they're going to be a fixed cost, and it may be a fixed cost that repeats. So it could happen again, but primarily those pans are going to last us quite a while. Cake retail boxes, those are going to be ones that for each cake we make, we're going to need another box. So that's going to be part of our variable expenses there. Cake delivery fee. Again, a variable cost. So as the cakes go out, we know that that delivery fee is connected to each sale of an additional cake. Floor cleaner, we're going to have to buy a floor cleaner. It's more of a fixed cost. It isn't really impacted by how many cupcakes. Sprinkles, we sell a lot of cupcakes and my kids love cupcakes with sprinkles. They always look for the sprinkles. It doesn't matter if it's a donut or a cupcake. They love the sprinkles. So that's going to be a variable cost. So more sprinkles, more cupcakes. Repairs to the oven. We talked about those emergency expenses that you might run into. That's a perfect example of why you want to have some kind of emergency fund. It's tough to budget for a repair of the oven. You just don't know what's going to pop up. That's going to be part of your fixed costs. Bank loan payment, the bank wants to see you successful. They want to see you do well, but the payment isn't impacted by the sales at all. So that bank loan payment is going to be a fixed cost. And then sales tax is an interesting one. So we don't really think about sales tax necessarily as an expense, but depending on how we're collecting it from the customer, it's still going to be due in some format. So hopefully we're, within our point of sale system, we're tacking on the sales tax, and that's not a surprise for us, but that's actually going to be variable. So as we sell more things, then we're going to have that sales tax. So, but take some time, write down your variable costs, write down your fixed costs. It will be very helpful for you. All right, we'll try to click on to the next one here. Okay. All right, so cash flow is the key. We see businesses come in and they put together a budget, and all across is the same revenue amount. It's just bing, 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 all the way across the board. The first thing we ask them is there seasonality in your business? And I would say probably 95% of businesses, maybe 90%, have some seasonality incorporated in there. And some seasonality is way different than others. If I think about like a retail clothing store, I think about Christmas time. Everybody may be going out to shop, buying clothes for winter, things like that. So that may shoot up quite a bit in that November, December timeframe. January and February, that's when all the clearance deals happen. The clearance racks come out and they're trying to get rid of last year's inventory. So the seasonality of that is really obvious that November, December is going to be super strong, whereas January and February are going to be weaker times. That may go for any business. So just looking at and seeing when's it going to be busy, when's it going to be slow. Now, you might ask yourself, do I need a line of credit from the bank? A line of credit can be very useful. So if you have times where it's super, super busy, and then you have other times of year where it's super slow, you might need a line of credit to the bank to draw down during those slow times. So maybe January and February for my retail clothing store is slow. I might have to draw down some from that line of credit to pay for my rent, my utilities, and things like that. Now, when I get into probably April, May, where new spring lines come out and people get excited about the weather changing, that might be a better time for me. So I may not need that line of credit. As my sales bump up, I pay down that line of credit. I'm in good shape. So you can actually build a line of credit into your budget. So at this time I'm going to draw down this amount, and then I'm going to pay it back here through my revenue as an expense. So key thing, revenue does not equal profit. Some people hear revenue and they think, well, that's the profit. That's what I'm going to make. They see money coming into their business account and they think they're making money, but they haven't really processed everything and seen what the expenses are compared to that revenue and looked at it and said, okay, did I really make money? And maybe I did. So know where you're at, really know where you're at in terms of cash flow. That's really the key to any successful business. All right, financial projections. We're going to take a quick look at this. So in this case, my total sales are $61,500 for these 3 months. My variable cost is $3,075. So I've got a great margin. I got a fantastic margin. So I brought in $61,500 in revenue. My cost of goods sold is $3,075. My contribution is $58,425. What does that contribution mean? Well, that means what can I pay for my fixed costs? Now, if I look at this here, I've got owner salary, I've got employee wages, I've got benefits, I've got marketing, utilities, internet, a lot of the things that you're going to have in most businesses. If I total this up, my total fixed cost for this 3-month time span was $20,310. Now, if my contribution was $58,425, I covered my variable costs. I made money that way. Did I cash flow during these 3 months? So that's the question. What do y'all think? Go ahead and post in the Q&A if you think this company is doing well or not doing well. Any thoughts? All right, I'm gonna answer your question for you. They're doing very well. So their contribution, their revenue minus the variable cost was 58,425. Total fixed costs were 20,310. The difference between these two was their actual cash flow. So around $38,115 or roughly that amount. So this company is doing very well. Now, I didn't have any kind of debt service in here, so maybe they have some kind of loan on their business that might eat into those a little bit. There may be expenses that were missed, but if this is all they have, they're doing very well. Go on to the next one here. My keyboard seems to work about half the time. There we go. So working capital cycle. This is something really to consider in your business. Very important, particularly if you sell things and give credit for your customers. And I'm not talking credit cards, but actual credit for the time they have to pay it. Or you purchase things that have a net 30 or a net 15 or whatever it might be. Now, in this case, we're going to look at the capital cycle. So my invoices, I have a net 30 for my business. So I'm going to give my customers 30 days to pay me for the widgets that they order. Say it's corporations and they order cupcake deliveries to their corporate office and they only pay every 30 days through their AP system. So from my shelf time, I hope it's not 12 days for my cakes. That would be kind of bad, but we'll just say 12 days average for something here. So I have a 12-day average where my item sits on a shelf before my customer even purchases it. Once they purchase it, they have 30 days to pay me. It takes 4 days for my accounting department to send invoices. And maybe you're doing this in-house if you're a small business, or maybe you're a larger business and you have an accounting department. The mail service is 3 days, which now it's probably longer than that. And then I have 30 days to pay my suppliers. So breaking this down, here's my 30 days for my payment to my customers. I have to add in my shelf time of 12 days. I have to add in my AP processing time of 4 days. And I have to add in my mail service of 3 days. So I subtract out my 30 days supplier deadline and I have 19 days. So what does this 19 days mean? This means for 19 days, I have purchased something, cost of goods sold, cost of services sold, whatever it might be. But on the other side, I haven't got paid for it. I've sold the item, a customer has purchased it, but they haven't paid me for it. So I have to have some kind of working capital to cover me for this 19 days. So there has to be something in there that's covering the difference between what I'm purchasing and what they're paying me. So whatever my cost of goods sold or cost of services sold are, I have to cover myself for those 19 days. Now, this may not apply to every business. So if I have a restaurant, people come in the door, they order the food, hopefully they like it. They pay with their credit card or cash. It's processed there. Boom, it's in my cash register. I have it. There's no worry about it, any kind of capital cycle or any kind of inventory cycle or anything like that. But if I sell something, I sell it on credit to those customers, I really have to keep this in mind. It's a very important part of that budget process. All right, so what are my resources? So NBDC Small Business Development Center, again, there are small business development centers all over the country. So no matter where you're located, what state, if you have friends and family that are in Seattle, Washington, they say, hey, I'm interested in starting a small business, tell them to contact their Small Business Development Center in that area. They're going to help them out tremendously. All throughout Nebraska, so every county, we have coverage for small business development centers. Local library is a great resource, free resource. So check out your local library. There's all kinds of things there. Accountants are great resources. So if you utilize an accountant or you're gonna hire an accountant, having them help with that budget process, that's really a nice thing. Vendors and suppliers are great. Contacting them and saying, what's it going to cost me for this particular supply, or what's it going to cost me for this item I'm going to put in my cake? And don't be afraid to negotiate those two. Tell them you're a startup, you're just starting off. Maybe they'll cut you a break. So uh, other resources, QuickBooks. A lot of people use QuickBooks. There's some budget things that you can do there. You can easily track expenses and revenue. Excel, we talked about. That's a great resource. There's all kinds of online templates. So if you type in any kind of budget format, there's all kinds of templates that'll pop up online. Just make sure that you're not having to purchase templates. We have free templates at the NBDC that we utilize for budgets. So don't purchase any if you see any out there. Free ones usually work pretty good. All kinds of workshops like this one. So DoSpace does all kinds of great things. There's all kinds of things around our ecosystem for stuff like this. So keep on the eye, keep your eye out for events like this. Industry benchmarks are huge. You can find them online a lot of times, but if you can't find them, come to us. We'll help you with that. So we've got resources through the college, all kinds of market research resources through the college that the small business just can't afford. I mean, we're talking 10, 15, 20,000 a year systems that we use for market research. And then lastly, market research. So, finding out what do those benchmarks look like? What are my peers doing? Determining what's happening in your market. So, don't wait for tomorrow when you can start today. That's the big thing I would say. Don't wait around to start your budget. Really jump into it right off the bat. What you don't want to do is you don't want to find yourself in a situation where, you're struggling, can't figure out where the money's going, your reserves gone, any kind of, buffer that you had is gone, and then you're going, what happened? So you don't want to be in that situation. You want to build those financials ahead of time so you can see in real time, how am I doing? How's the cash flow look? How do things look compared to my budget? So tracking that is really important. All right, so in a review, research equals accuracy. So the more research you can do, the more resources that you utilize, the more things you reach out, the more accurate your budget's going to be. I can throw down any number I want on a piece of paper in an Excel form, but it doesn't mean that that's a realistic number. I need to have something backing it saying, if I'm going to open a coffee shop, and I'm going to open the coffee shop at this location, here's what I should expect for revenue. I can throw in there $3 million, but chances are probably pretty good my coffee shop that's brand new isn't going to do $3 million in revenue. So comparing your budget to benchmarks, that's really a key part of startup businesses, is building that cash flow projection and comparing it to those benchmarks. Again, write out your fixed costs and your variable costs. Take time to do that. That's very, very important. Do that budget analysis. So don't just do the budget, throw it on the shelf and call it good. Go through, look at those numbers, throw in those actuals as they pop in. So when I managed a regional shopping center in central Nebraska, we did a budget analysis every single month. And if there were any expenses that were off, I think it was between 5,000 and 10%, I had to actually provide a comment of why that was off. And a lot of times I didn't know. I had to actually go back through the general ledger and see what expenses were in that category and what came in that we didn't anticipate that came in, and then add a note to that so ownership knew what was going on. Consider cash flow. It's your most important thing. It's the lifeblood of your business, is the cash flow. And then just remember your resources. NBDC, free resource. Local library, free resource. Your accountant, vendors and suppliers. And there's all kinds of other people out there in the ecosystem that can help you out. So utilize those free resources because they're out there. All right, Q&A. I'm going to start off and I'm going to jump to the Q&A here. And I'm going to start from the beginning. So the first question was, what's the difference between SCORE and the NBDC? So SCORE, it's interesting. They have interesting history. Originally, they started as they were retired executives. And I don't remember the exact acronym, but it was the group of retired executives. And these retired executives wanted to give back to business. So they offered free consulting services. And what it kind of morphed into is it's not retired executives anymore. It's people that are in business that want to give back their time and volunteer, and they really want to give back to the community. The thing that we utilize SCORE mostly for is if there's a specific business that we're not super familiar with, and that person needs mentorship. SCORE is an excellent resource for mentorship. So say somebody wants to start, a restaurant, maybe it's specific to someone that has operated restaurants. They can mentor them and help them through. Now, the Nebraska Business Development Center, we basically support small businesses through market research, helping build business plans, helping build financial analysis. We'll do help people with marketing plans. We'll look at operations too, but if it's an area that is just outside of our realm, I'm not going to tell you how to run a restaurant because I've never run a restaurant. So I'm going to send you over to SCORE and say, go talk to these guys about running a restaurant. The cool thing about the ecosystem is we collaborate with all kinds of groups, whether it's SCORE, might be Nebraska Enterprise Fund, it might be, other organizations that are out there, SBA, the local district SBA office we work with. So those are all resources that are out there that we work with. MLCDC, Catholic Charities. I can go on and on. The Greater Omaha Chamber of Commerce, REACH program we work with a lot. So those are all groups that are out there in the ecosystem. Where are you finding these numbers? How do I figure cost of sales for a consulting company? My easiest answer to that is probably reach out to us. And what we'll look at is we'll look at the type of consulting company it is, and we'll pull up market data on that. What's interesting is every company is different. So a consulting company for construction might be way different than the consulting company for, say, human resources. So we would go through, we would try to figure out that information. My next slide, I'll actually pull up my contact information. So if you want to zip me an email, we can certainly get you signed up as a client. So excellent question there. Next question. Okay, we had what the variable and the fixed were, so that's good. Next question, is this accurate? Revenue minus variable costs equals contribution. Contribution minus fixed costs equals cash flow. That is right on the money. So your revenue you bring in, you take out your variable cost for that. That's going to be your contribution or your contribution margin. And you can break it down to a single unit. So if I'm selling cups of coffee and I'm getting $1 for a cup of coffee and I'm selling it, or I'm sorry, if I'm selling it for $1 and it costs me 10 cents to make that cup of coffee, I know 90 cents is my contribution margin per unit. So every time I sell a unit of coffee, that contribution margin is 90%. And then I take that total contribution amount, however many units I sell times that 90 cents, I subtract my fixed cost. That's going to tell me what my cash flow is. So that is right on. Any other questions for the chat? We're getting close to our time here. I'm going to go to the next slide, and you can see my contact information. Hopefully. There it is. So feel free to email me. We set up one-on-one consulting. So you're connected with a consultant. You meet with them one-on-one. We're doing everything via Zoom right now. But eventually we're going to get back to probably a hybrid model where we do some in person and some over Zoom, whichever is more efficient for our clients. But feel free to drop me an email. We'll get you set up with a sign-up link if you're interested, and go from there. So I thank you for the time. I thank you to our friends at Do Space for inviting us and for Startup Omaha. It's a great program. It's a great resource. And there's all kinds of other resources that are out there. So please take advantage of those. So another question came in. Have you happened upon a great budget template to take advantage of? I happen to have one that I use personally. if that's something that you want, just drop me an email and I can send it over to you. So
Awesome. Well, thank you so much, Tony, and thanks to everybody else who joined us today. Keep an eye on our calendar on our website for the rest of our Start Omaha Week events. Thank you, everybody. Have a good day.